Yeah, to those people who just joined, I'd like to say thank you for coming to our webinar today. As I'm sure many of you know, the Junior Economic Club is honored to have Catherine Mann, the Global Chief Economist at Citi, here to talk to you about US trade today. The Junior Economic Club was founded in 2014 and is an entirely student-run nonprofit that fosters a community of driven high school students and business leaders. JEC offers students exposure to business and economics concepts that are not taught in school, and the club has over 130 students representing over 25 high schools across Chicago, as well as chapters in 9 cities across 4 countries. And you can learn more about the club and admissions at junioreconomicclub.org/home.
You're doing
Yeah.
Okay, who was talking? I know. Are you going to take a few notes?
Okay. So with that, I believe we can get started. So yeah, so just to introduce, Catherine Mann is the Global Chief Economist at Citi. She has a Bachelor of Arts in Economics from Harvard and a PhD in Economics from MIT. In the past, she has been the Senior International Economist in the George H.W. Bush Administration's Council of Economic Advisors. Then she was a Senior Economist at the Federal Reserve. She was a Rosenberg Professor of Global Finance at Brandeis and a Chief Economist at the OECD. And yeah, Ms. Mann, if you'd like to start your presentation on U.S. trade.
Sure. Well, thanks very much, Leo and Lizzie, for the introduction and for the invitation to come and chat with you folks about trade. I'm not going to talk just about U.S. trade. I'm also going to talk about trade in the global context. So let's go with the sharing the screen issue here. It's always a challenge to make sure it works. But, here, yep, we're good. We're good. So when Leo and Lizzie sent over the material saying what you guys were interested in, it came out that you were interested in U.S. trade, but you were also interested in some issues with regard to debt and with regard to climate change. So that's the set of topics that I've got here is we're going to talk a little bit about the global economic outlook. And then think about trade issues in the long term and the short term, and then also talk about climate change. And we can make sure we get this to work, maybe. Here we go. All right, so I really think that we also need to talk about where we are in terms of the global economy, because trade is an integral part of how countries are knit together in the global economy. Where we are right now, of course, we're in the midst of a pandemic, and there are multiple ways in which this pandemic has affected the global prospects, and of course, the prospects for individual countries, and of course, at the micro level, individuals as well within those economies. So, so it really is starting at the micro level and then building up to the global economy. Of course, the other thing about this pandemic that I think is important to consider is that it really has affected everyone, but not at the same time. And so it's this sort of asynchronous cycle of getting the virus, then improving situation, and then the second wave. These are all important ingredients for how trade is affected and how the global economy is affected. So I'm going to talk through these 3 components to this slide here, how COVID is affecting each one of them, how that impinges upon how countries are related to each other through trade, and how ultimately we're going to see how that affects prospects for the global economy in terms of economic measures such as GDP, also living standards and debt. So the first thing, of course, that COVID has done is it's affected consumers. That's, of course, because individuals are the ones who get the disease, and that has impact on lockdowns, that has been met by lockdowns, it's been met by fear, a fear of going out, and so implications for consumption, because there's a lot of things you can't consume anymore. It's very hard to go to a restaurant, you can't go to the theater, people are not too thrilled about going traveling. And so this is a manifestation, this fear as well as the lockdowns are a manifestation of consumer concerns. The chart that you see there on the left-hand side compares fear of getting COVID using a YouGov poll on the vertical axis with retail sales on the horizontal axis. And the fact that you see a downward sloping line is indicative of the fact that the more afraid you are, the less likely you're going to go shopping. And so there's a correlation between fear and negative retail sales. In other words, a contraction of retail sales. The countries that you see there listed are the European economies, but this is something that we see in other economies as well. Now, there are some interesting high frequency relationships between fear of COVID, or that sort of weaken the relationship between fear of COVID and retail sales. And that's because in a lot of countries, including the United States, there have been a lot of unemployment programs put into place to try to bolster people's spending power, even though that they are out of work. We call them fiscal life preservers because they're just trying to offset the unemployment, offset the consequences of the lockdown. But of course, when people can't spend on restaurants or entertainment or travel, there is a rotation into retail sales. So in some sense, the negative numbers or the negative correlation that you see there would be even worse, except for that there has been a lot of support in the fiscal arena for unemployment compensation and so forth, and you can't spend money on other things. But nevertheless, a lot of headwind for growth coming through consumers' behavior and their fear of COVID. The second, so let's go over to the right-hand panel and let's talk about business investment. You see there a number of different indicators for the growth in business investment, so-called CapEx for capital expenditures, but it also includes things like intangible capital, meaning computer software, that sort of thing. What you can see there is at the zero line where we are headed into 2020, a real collapse. In other words, a contraction of business investment. And of course, why is that? First, if you don't think there's going to be any demand for your product, why should you be building new capacity? And number two, if you're very uncertain about prospects, not about for your own product, but also for the domestic economy and the global economy more generally, you're less likely to engage in investment. And so that's why we see this collapse in business investment. Now, I want you to remember that chart because we're going to come back to it again when we talk about sort of long-term scarring that comes from the trade wars and from COVID. So what you see in the center panel is what's going on with trade. The dark blue line are the numbers for trade, so-called Global Trade Index, so it's the volume of trade. And of course, what you can see is that dark blue line, you can see where the zero is on the zero axis, and you can see that trade started to contract last year, and it continues to contract now. In other words, trade is shrinking. So the relationship between countries, the importance of trade has been shrinking since last year, and that's of course because of the trade wars. Trade wars cause trade to shrink. We're going to look a little bit in more depth at that in a minute. So the trade wars started trade off in a bad shape going into 2020, and it has just continued to get worse. We also don't see any improvement going forward. There is the light blue line. There is a so-called container throughput index. It's something that we look at. It's a monthly index, and it kind of tells you, containers moving around the boats and in the ports, like Long Beach, for example. And for example, it would also show up in terms of what shows up on trains, which of course Chicago is very big interchange for train shipments. And you can see that that was also showing us that we do not see improvement going forward. We can also look at data, for example, export orders, export order books, and those also don't show any improvement in trade. So this relationship that countries have with each other, very damaged by the trade wars, continues to be damaged by COVID. So those are all headwinds. They make it very difficult for economies to do well, to grow, and of course are part of the reason for the high unemployment rate. So I wanted, though, to put the trade, these are very current data that we were just talking about. I thought it was important to put that in a longer term context, sort of giving you sort of a sweep of history about what's been going on with trade. And so that's what you see in the left-hand panel. And what you see there is going back to 1960 and up to 2017. What's been going on with this concept called trade integration? And what we mean by that is if you take exports and imports and you divide it by GDP, it's a sense of how important trade and trade linkages is for economic activity. So this upward sweep of the line that you saw sort of beginning in 1960, and then those bars, blue bars, are the different time periods when there were these so-called multilateral trade negotiations. I don't know whether you've heard about those or not. They aren't really a big deal these days, but you know, in a time, the Kennedy round, post World War II, opening up of trade, reducing tariffs being very important as the first time there was really a return to a lot of trade between countries. You can see back in the 1960s, trade integration, trade as a share of GDP was only about 25%. And then you can see these other rounds, the Tokyo round in the 70s, then the Uruguay round and the European Union single market. You perhaps have heard about that one. Then NAFTA, no doubt you know about that one, Chicago being very close to the Canadian border. Then what you see, so you see this rising role of trade integration, trade becoming more important in economies, more important for companies, more important for workers in terms of how they relate to each other into the global economy. But then, what do you see kind of most recently, basically in the last, almost since the year 2000, so, excuse me, almost basically since the year 2008, there's basically no change in global integration. So there's been a stalling of trade integration, and it started to stall more than a decade ago. And so what has been happening with the trade wars last year and now with COVID was happening against a backdrop where trade integration had already stopped. And all of the good things, and we can talk about what those might be, all the good things associated with trade integration really stalled. Now, if you look at, like, why did that happen? Why did we have a stalling in trade integration? You could look at the right-hand panel, and that's all those bars are to facilitate trade across borders so that consumers could get products that they couldn't get at home at a better price, so that businesses could sell into other markets that they couldn't get into before because there were tariffs. And so these bilateral, plurilateral, and multilateral agreements really started to dramatically stall. And so what you see there is the stalling of trade integration is on account of a failure to commit to trade liberalization. So as trade liberalization faltered, you can see all those agreements, those little bars falling down. That means that there was less and less interest on the part of individual countries to deepen their relationships, to open their markets, to provide more opportunities for companies to sell into those other markets and for consumers to buy products that they weren't able to get at home. So I think it's important to have this broader context for what's going on with trade in today's, with the trade war and with COVID. Now, I suppose with trade, people kind of ask this question. We're going to pivot now back to the sort of the last year and the trade war with China. Do tariffs really matter? And the answer is yes, they do. And so the left-hand panel gives you an idea of all the different, there were lots of different tariffs put on, lots of different products last year as part of the US-China trade war. And there were different time periods. First it was on capital goods, that was the dark blue line. Then they added on for more tariffs, that was the red, sort of the blue and the red. And only at the very end did they start to put tariffs on some of the most important consumer-facing products, electronics, cars, that sort of things. Those were the pink, the gray and the pink. Now, if you look over on the right-hand side, you can see what happened to trade in those different product categories. The person who made this chart, great guy, coordinated his colors so that you can see how different product categories collapsed over time, with the earliest product categories in the dark blue, even though those tariffs were pretty small, had immediate impact on trade between, on the imports, US imports from that economy. So you put on tariffs, products get more expensive, you don't buy them anymore. So yes, tariffs really matter. Now the question is, and one of the questions that you were curious about is, you know, if tariffs matter and we weren't buying things from China, and that chart basically says no, we weren't buying them from China, kind of what happens then? And there are three possibilities. One is that you just don't buy it anymore. Number two is you buy it from someplace else, some other country. And the third one is that you bring it back home. You buy it from home producers. So we had to, you know, we spent a lot of time looking at all these issues, and the bottom line was there was most of it was trade reorientation. In other words, not buying product from the United States. In major reason was the US wasn't producing many of these things. Instead, there was a search for what other countries you might buy from. So that's, you know, the way we wanted to kind of think about it. Now, this chart, rather than looking at trade with China, because we just saw that we weren't going to buy it from China. So if imports, you know, US didn't import stuff from China, and it also didn't buy it from like a home producer, kind of, how does that all work? So the story is that there are two components. One is supply chain vulnerability, and the second is trade diversion. So let's talk about each one of these. Let's suppose we bought something from China. I'm just going to call it a widget, because that's what economists do when they don't want to talk about a specific project. They call it a widget. So widgets that we bought from China are part of a global supply chain. Like China gets imports, they then add value added, and then they sell it to the United States. So the first question about how China trade war would affect the global economy is the supply chain vulnerability. So here's a widget. We used to buy it from China. Which countries are going to be hurt because we don't buy from China anymore? And so their supply chain relationship is broken. So you can see the countries listed there. Taiwan, that's TW. Taiwan was the most exposed, Singapore the next, then Korea, Vietnam, Malaysia, and Thailand. And the numbers are the share of their GDP that was at risk because the US wasn't buying widgets from China anymore. But then, of course, we are going to buy the widgets. We're not going to buy them from China anymore. We are going to buy widgets. So companies go and search for places that they can go buy widgets. And so that's the bottom panel. It's called trade diversion. Rather than buying the widget from China, we're going to buy the widget from somebody else. Where did we go, as you know, where did companies go to try to get those widgets? Well, they first went to Mexico and Canada. And those two countries are primarily, why were those the first places that companies looked for widgets that they used to buy from China? It's because of auto parts and electronics were very important components of those tariffed products with China. So Mexico and Canada got sort of the first benefit, so to speak, from the US-China trade war. But then look at the other countries, Vietnam, Malaysia, and Thailand. They were hurt through supply chain vulnerability, but they began to become the destination to look for directly for widgets. So Vietnam, Malaysia, and Thailand lost from supply chain relationships, but gained through trade diversion. A country like Korea did not. You can also, adding up the numbers on the top of the screen, top of each bar, you can tell that in the end, everybody lost. But it's all, relatively speaking. Oops, down and down. All right, so that gives you some kind of flavor for how China was affected, the US imports for China was affected by the trade wars, and how did it percolate through economies, right? Now, this chart takes a macroeconomic perspective and asks the question, just how bad could the trade war be? And through what channels? I already told you that trade reorientation channel, but the panel on the left-hand side with the various colors there, dark blue, light blue, gray, and red in the line, this gives you an idea of just how bad we thought the US-China trade wars would be last year. Now, of course, this is pre-COVID when we did this exercise, but at the time, we parameterized the types of losses as first this trade reorientation loss, which is that dark blue component. It represents about 50 basis points. So rather than the global economy growing at about 2.8%, it grows at about 2.6. So we have about 20 basis points loss in global growth on account of the US-China trade war. But of course, that's not all that happens. Because you had to, you used to buy from China, but now you're going to buy it from somebody else, it gets more expensive. Because if you were going to buy it from somebody else already, you would have done that because it's cheaper. So you're not going to do that. But now you have to because of the tariff. And so that's going to affect companies' earnings. It's going to be costly, so they're not going to be able to have as much earnings. So affecting equity prices. So the stock market, and you could remember maybe last year, you might have remembered, stock market kind of went up and down a lot depending on how Trump tweeted and what happened with the tariffs and so forth. And so we looked at this and evaluated just how much the global economy could lose through lower equity prices. You lose it because companies aren't as valuable. People who own company stock don't feel as wealthy. Of course, the companies don't hire people because they're not earning as much. And so all of these channels represent that light blue component, which takes the global growth rate down to about 2.1%. So it's even more important, these equity market channels, these financial market channels, and their implications for company earnings, unemployment, and consumer confidence, that these are more important ingredients than just the tariffs themselves. And I think that's an important thing to remember because it means that the complexity of how trade wars can affect the economy, it's not just the tariffs. There's a lot of different channels through which tariffs can affect economic activity. Okay, now how did that add up? We thought that the U.S. economy, you can see that sort of in the middle set of bars there, that we thought that the U.S. economy would grow 1% slower in 2020 on account of the trade wars. Now, of course, we ended up with COVID instead. But if we put COVID and the trade wars together, this gives you an idea of how much global GDP gets hurt by COVID plus trade wars. So the economy at the beginning of this year, in January 2020, was sort of chunking along at about a 3% growth rate. That's represented by that dark blue line. And then there was trade wars, and then COVID hit. And then we ended up in contraction, a really dramatic contraction. And that's the dark blue dotted line. But, you know, we think the contraction actually is going to be worse. It's going to last longer because of the COVID fear factor, because of the supply chain and trade war sort of aftermath, plus business investment collapse. Don't forget that. And so we actually think that the global economy is going to grow much more like the yellow dotted line. And so a couple things to take away. T means it takes a long time to get back to where we were in January, Q1 2022. Okay, that's a long time to get back to where we started pre-COVID. So what does all of that mean kind of for longer term stuff? Things like living standards, things like the ability to repay debt. We've taken on an awful lot of additional debt in order to try to keep the economy afloat. We may take on more debt. You know, we're running a fiscal deficit. That means if you add up all the deficits, it adds up to debt. So how are we going to, you know, what's going to happen here? How are we going to take care of these longer term issues? And what about this permanent loss to GDP? That sounds, you know, that sounds pretty bad. So the way we think about how a couple of different ways to think about it, sort of central way of thinking about longer term issues is something called potential output. That's the capacity of the economy, if all of its resources are being utilized efficiently and effectively, along with productivity growth, how much can the economy produce? It's called potential output. And this is just a diagram of labor and capital put together and how you put them together in the form of productivity growth leads to output. So this comes from the Reserve Bank of Australia, nice little graphic. Now this is important because when we think about scarring, in other words, things that are things, you know, a scar, it's like something you are with all the time. And we talk about scarring in the context of labor markets, people who can't get a job, they can't get a job for a while, their skills don't match anymore. You've got technology changing, and so you thought you learned the right stuff, but no, turns out technology changes and you have to learn something else. So continuing learning processes is an important ingredient. So that labor market transformation and challenge is something that is being, you know, we are experiencing now labor market scarring coming from COVID. Capital, that is the, you know, capital stock in the economy. It's all the equipment and it's the computers and it's the, you know, energy production and all that kind of stuff. Well, I already told you that business investment has collapsed. Well, if you add up all business investment, that is what capital is. So business investment collapsing means that you have less capital. So we've got labor market scarring, reducing the amount of labor effectively in the economy because skills don't match so much anymore. And so people aren't really able to do as much. You've got capital stock in bad shape because of business investment collapsing. So it's going to be really important to be thinking about productivity in order to get to our high level of potential output, such that we can improve living standards and repay our debt. So here are some numbers. This is what some calculations that we've done in order to evaluate some of these consequences for the longer term. And what you see in there is the components that come from capital, that's the dark that's the dark blue. The component that comes from labor, so it's the gray, and then the implied productivity, which is TFP. And then the dots you see there is what we have as our projections for 2019 to 2024 for global growth. So a couple of things you can take away from this chart. First, labor market scarring has reduced contributions of labor. It used to be 1.79. Now in the forecast period, it's 1.38. Some of this is also aging and demographics. That capital stock problem with business investment contracting, capital used to account in the 20 to 2027, account for 1.92% component of growth. Look what it's going to do in the forecast period. it's a contraction. It takes away from growth because there's no business investment. And what is implied that has to be happening with productivity in order for us to get to what our guys are forecasting for global growth? It's a surge. It's a surge in productivity. Like that light blue section, you know, you don't see any of that light blue section anywhere at all that looks like the same numbers. So in order to get to what our economists think global growth is going to be going forward, it requires a surge in productivity. And so there's a real question mark about whether or not we're going to get that. So before I leave this, and I'm running out of time here. I think I have about 5 more minutes. You know, what do we think? So I've already said, okay, labor market scarring, demographics. This is what is one of the reasons why we have labor market input as being less. We've got the capital stock deteriorating because people aren't businesses aren't investing. And so there is an implied surge in productivity. So there are a bunch of things that are more likely to hold productivity back. For example, when trade is in contraction, that is negative for productivity, because if trade is in contraction, then businesses aren't you know, innovating, and they're not finding the best kind of cost structure for their products. People aren't buying things, so you don't have economies of scale. And so productivity is really being hindered by the trade contraction. But it's also true that productivity is worse when labor gets stuck and doesn't have talent, you know, doesn't have the matching talent for where the jobs are. And then finally, of course, capital stock contracting is also a headwind for productivity. So all of this trade wars, scarring of the labor market, contraction of capital stock in the face of uncertainty and COVID, all of that adds up to the problems with productivity as well. So let's just talk through a couple more slides and then we're done. What are the implications of low productivity for living standards? So what we've done here is, and the US is all the way on the right-hand side in case you just want to care about the US, but there are other countries here that we can talk about. The red dot, so what we care about, you know, living standards matter in a couple different ways. One is, how rich are you on average in a population? But another thing that we care about is, how has that living standard been growing over time? People care about not just how rich they are, but comparatively, like your parents. How much did your parents get richer in their lifetime versus do your parents think that you're going to get equally rich in your lifetime? So the rate of change in living standards is important. So the red dot there tells you what the rate of change of living standards was between 2011 and 2018. So it's an 8-year period. We like to take averages for these things rather than just year to year, because they do bounce around some. So that was what happened in the last 8 years, 7 years. The 2 bars there are 2 different scenarios for productivity growth. The blue bar is the productivity growth, the surge in productivity growth that we have assumed in the previous diagram for each of these countries. And then the light blue bar is the average of what TFP, the productivity growth, actually was over a very long period. The thing to take away from this chart is that for virtually no country, and certainly not the US, will a rise in living standards over our projection period match what people in countries actually experienced over the last 7 years, 2011 to 2018. So that's kind of grim, actually. So even with the surge in productivity that is assumed to get us to a more rapid rate of growth, we're still not going to do as well as we did in the previous 7 years. What does that do for another measure that we care about, which is our ability to repay debt? So again, debt is, we're building up a lot of debt, sovereign debt to kind of stave off disaster in the current situation. And that means that we're going to have to pay it back. So how do you pay back debt? You pay back debt out of your quote, earnings, which in the economy context is GDP. So we have to ask the question, how does potential output and GDP, is it quite kind of big enough to repay our debt obligations? So this chart is looking at what the average debt to GDP ratio was in the previous period, average that same time period, 2011-2018, and then under both of these scenarios of productivity growth. And again, the U.S. is third from the right, but again, for all of these countries except for a couple of them, the debt to GDP ratio is higher than it was in the previous time period. So we've got living standards that are growing more slowly, and our debt obligations are expanding. So that's not a good combination. Our living standards are growing more slowly, our debt obligations are increasing. So the last slide I think I've got here is, who's going to pay? How are we going to pay it off? So this is a picture of OECD economies. We also have it for the US. I didn't want to show that because it's really depressing. But what this chart shows you is the trajectory for earnings over lifetimes by birth cohort. We call them cohorts. So you've got on the bottom axis, the horizontal axis, the age of people. And on the vertical axis, you've got how much money they have, basically. And then each line represents a birth cohort. So for example, if you were born in 1940, you had a rise in your income. It starts out pretty low at about $9,000. And then after, when you were 20 to 24 years old, then you actually had a big boost in your earnings to about $14,000 post-war. Everybody got back to work, economy was growing again. And you can also see that over people's lifetime, they pretty much had a permanent increase in their earnings. As they got older, earnings went up and up and up. And then finally they retired at mid-60s. You can show this for each one. The 1950s generation in light blue, they retired a little bit earlier. The 1960s generation, same thing. But look at the 1970s generation and 1980s, we don't have as much information yet on them, but the 1970s generation, in their prime earning years, in their mid-40s, they've already have turned over. And they're not following this pattern of continuing rise of earnings over their lifetime. Now this is a manifestation of all of the scarring and all of the slowdown in trade, this trade in the last 10 years, trade integration stopping, the slowdown in productivity growth. All of this adds up to burden on a younger cohort at a time when our debt obligations are rising. So it's a significant challenge for the longer term of how to turn this around. I do have the other slides. That's what the last slide is on. How does the green fit in? Can the climate commitment help? Or is the climate commitment going to be worse? So I'm going to skip that slide and go to the last one. Some people say if we try to, I basically painted a picture that was kind of grim. Living standards shrinking, debt rising, younger cohorts being worse off. That's not a good picture. So the answer, the question then becomes, well, under those circumstances, how could you possibly be talking about, climate? Good grief, other than the fact that it's, going to be even worse than COVID. The story is that in a world where we're looking for prospects to improve the state of the economy, to grow faster and be more productive and hire more people and pay them more, where do we go and find what is like a holy grail? As it turns out, climate can be that. It can be that. And this slide is really complex. It's something I did when I was at the OECD, my team's there. But the story is basically this. If governments set up the right set of policies, the incentives to get consumers to demand cleaner environment, the incentives to demand that businesses invest in the innovation, adaptation, mitigation of CO2 transmission. That innovation, that investment is a strategy whereby you get the investment that you need to support capital investment and potential output. You get innovation in order to get higher productivity growth, and you get more employment in order to bring those people back into the labor force and into jobs. So that pretty much goes through our short-term headwinds from COVID, a long-standing problem with trade, which was exacerbated by the trade wars last year, and a second round exacerbated by the COVID crisis, the collapse of business investment, its implications for longer-term capacity of an economy to deliver living standards and repay obligations. How do you make it happen? You can if you have the right type of policies being promoted at the global policymaker level. Do we think that's going to happen? Well, maybe that's a good question for us to ask. So I'll stop sharing at this point, and now I think we can move on to questions.
Yes, thank you, Ms. Mann. That was very interesting. So some of these questions you kind of went over a bit in your presentation, but just if you have anything to add. So the first one is, how does the US trade deficit affect the national debt?
That's it. I mean, this is a good question. There's a lot of people who think there's this so-called concept called the twin deficits. And so how, what is that? That is that if there is a trade deficit, it's because there is a fiscal deficit. Okay, a fiscal deficit, if you add up all the fiscal deficits, that's where you get the debt from. You can think of it, deficit is a flow concept, debt is a stock concept. So how does the US trade deficit affect the national debt? If you look at an equation, as economists, we call them equilibrium conditions, but that doesn't, maybe I won't say that. It's an algebraic relationship that says if you have, it's called savings minus investment plus taxes minus government spending equals exports minus imports. So they're like accounts, that's where all our data come from, national accounts. And the national accounts have to add up. And the one way they add up is this savings minus investment plus taxes minus government spending is equal to exports minus imports. So that's where people get this notion that if you have a trade deficit, exports minus imports being negative, then you also have a fiscal deficit, meaning taxes minus government spending is also negative. But that thought process ignores investment minus savings, or savings minus investment. And so there does not have to be a algebraic relationship between a trade deficit and the national debt. Because what also is important in determining what might be happening with either the fiscal deficit or the trade deficit is the relationship between private sector investment and private sector savings. So that's a very important ingredient to think about. For example, you could run a fiscal, a fiscal balance of taxes and government spending are equal. And you could still have a trade deficit because investment is booming. And when investment booms, some of the products, some of the capital that you use for investment, you import some of it. So you would have an investment boom, you have imports, so you would have those two balances, but this would be a good story for global growth because investment at important foundation for productivity, important foundation for potential output, as I described it. So the two of them can be seen as twins, but you have to leave. There's another character out there that you really have to be aware of before making any judgments about how the two deficits are related to each other.
Yeah, thank you. And then the next question, how has COVID-19 impacted the US-China trade war, and should the US modify existing tariffs on China?
So we talked a little bit in general about the US-China trade war, but this is a question that's a little bit more specific about kind of what's going on right now. Now, you know that there were several different over the course of last year, tariffs were put on more and more different products. That's one of the charts that I showed. January this year, there was an agreement, so-called Phase 1 agreement, whereby China would buy some specific amount of specific products. Internally, we always call this the shopping list. In other words, the US said, here, China, we want you to shop in the US for these things. And that, so I mean, we weren't overwhelmed by that quality of that trade agreement was pretty limited in terms of, it was very, very quantitative. There was no way in which it was, it was very formulaic. So they say it's a shopping list. Now, what has happened, of course, is a couple of different things. COVID did make it difficult for China to buy the things on the shopping list in the order and the amounts that they were quote, supposed to buy according to the shopping list, because plants were closed, first in China, then in the United States. So that was an important issue. Then, of course, there were also problems with certain, some of the plants in the United States, for example, pork. Pork was a big part of what China was supposed to buy. China's had problem with its own pork farms, some diseases. And in the US, there were problems with the pork as well, because the packing plants, there was COVID cases in the packing plants and they closed down. So China literally couldn't buy the pork. I mean, there wasn't even pork in the grocery stores. So that has impacted the purchases of China. And then, of course, there have been other issues. For example, China was supposed to buy a lot of those airplanes that had a problem. I'm not going to tell you which airline company that was or which airplane it was, but China was supposed to buy a lot of them. And of course, those types of planes are not flying. I'm not allowed to talk about specific companies. That's why I'm not naming names, but of course, if you read headlines. So they couldn't buy those airplanes. So there were a lot of reasons for why China really couldn't perform on buying the shopping list. But let's face it, there's also a lot of political issues in the trade arena, in the technology arena, and so forth, as well as other political issues that have also made China maybe not so willing to buy the products that they said that were on the shopping list. Finally, you know that this last weekend, they were supposed to have a discussion about the status of Phase 1, this Phase 1 agreement, and those talks did not happen. I think it's fair to say that the U.S.-China relationship is a very difficult one right now. And it's very much part of both COVID as well as the electoral calendar. Should the U.S. modify existing tariffs on China? It's a complex question. I think I didn't think that they should have put them on to begin with. I think that they should have had multilateral negotiations in the WTO with allies, Japan and the European Union, which in March last year looked like that was the way it was going to go. And then of course that fell apart. You can't deal with China using tariffs. You have to do other strategies, and you have to do it in a multilateral way with allies. It's not a bilateral thing. It's something that has to be dealt with on a multilateral basis. All right.
Yeah, and then this you kind of went over in your presentation, but will manufacturing jobs come back to the US as a result of the trade war, or will they shift to other developing nations?
So I think an important distinction that I think needs to be made here is it may be true that some manufacturing production will come back to the United States, but will there be jobs? The two of them are not the same. The two of them are not the same. And manufacturing in general, around the world, the number of jobs it takes to create, I was calling it widgets, right? The number of jobs it takes to create a widget, whether that's a producer, the widget is produced in China or in Canada or the United States or France, everywhere around the world, the number of jobs that you need to produce a widget has fallen dramatically because of the implementation of technology on the factory floor. So you could have production coming back to the United States as part of a general supply chain reoptimization strategy that a lot of companies are looking at, where they're looking at providing more visibility and transparency into their supply chains, so that you know exactly where everything is produced. Certainly, and consumers want to know, like, where did this come from? Investors want to know if they're part of an ESG portfolio, environment, social, and governance portfolio. So visibility and transparency of the supply chain is important now. Diversification and localization, increasingly important, again, because of carbon footprint, but also because of the desire to have multiple locations, not all your eggs in one basket. And number three, to have a lot of flexibility to move product. I'm going to buy it from this plant versus that plant. So those three pillars of the new supply chain reorientation and new supply chain optimization strategies that companies are thinking about, all of that may lead to manufacturing coming back to the United States. But the question mark about jobs is a different one. The manufacturing will come back, but it will be much more technology intensive. And so the number of jobs will be quite limited.
Yeah, so that's definitely an interesting point about the distinction between jobs and technology. So the next question, how are the effects of COVID-19 different from the effects of other US trade disruptions?
Yeah, this is a good question. So I talked a little bit about the types of products that the tariffs were put on, that the US put on tariffs on China products. Those are all products. There were no services there. And COVID is something that has hurt services. And that's the principal consequence of COVID is services, restaurants, tourism, entertainment. And so the two of them actually and now of course that has implications. I mean, services there are traded services. I mean, tourism is a traded service, right? Every time you go to another country, it shows up in the balance of payments. But most of the most trade wars that we've had last year and in general. It's about manufactured products or industrial supplies and materials, things like chemicals, steel, autos, and COVID is much more about services. And so it really has a different way in which it affects the economy and the sectors and the types of businesses that are affected. Of course, there's, as I say, there's crossovers where tourism is a really interesting crossover, aviation, really interesting crossover. But you can still, think about how they are different. Still think about how they're different.
Yeah, for sure. So then this is kind of on a different note, but what might cause international investors to lose faith in US Treasury bonds? And what do you think would happen as a result of that?
Yeah, so I mean, this is of course a very interesting question that internally in our research within Citi, we pay a lot of attention to this. So a couple of issues. Of course, investors have to allocate their portfolio, and so they have to look at not just how COVID or how policies or how trade wars or whatever are affecting the US economy. They also have to look at all those things as to how they're affecting other countries as well. So this is where, we got to look at the global context. Because I'm an investor, I have to look at a lot of different possible places for me to put my investment. So it may be that I don't really like US Treasury bonds because the US is running this really big deficit and it's got this trade war going on. But, the alternatives might be worse. And as a result, I kind of get backed into holding US Treasury bonds, not because I really want them, but because the other alternatives in the sovereign bond category are worse. Now, an interesting scenario here is, people say, well, what about, buying Chinese government bonds, something like that? They earn, they're giving a pretty high return. I think it's 5%. Why not just, buy a lot of Chinese government bonds? Well, of course, people worry a little bit about how liquid that market is, how much it's, the US Treasury bond market is ginormous, and the Chinese market is not so much. Plus, of course, it's in RMB. That's the, renminbi is the currency, and that means that you have to figure out how you're going to get renminbi. It's not convertible, which means you can't kind of just like go get it out of the ATM machine or something. So that's why Chinese government bonds are yielding 5%, is because they've got these liquidity problems. What about European bonds? Okay, so there are a lot of bonds in Europe, sovereign bonds, Germany, France, Italy, so forth, Portugal. Each country within Europe has its own sovereign bond. A lot of them are yielding negative rates of return, like actually the German government, that you pay the German government to buy their bond, right? So it's negative nominal rates, not real rates, nominal rates. So, it's like, well, I don't want to do that. it's a negative, I have to pay them. I don't think I want to do that. But there is this new European bond that's just been kind of, they're in the process of kind of getting it in gear. Supranational, meaning it's above the nation state. Okay, or you can either call it supranational, or you could call it pan-European, depending on kind of like what vocabulary you want to use. And what this is it's part of the European Recovery Fund, which has been agreed to by all of the European economies, and it allows the European Parliament and the European they don't really have a fiscal authority. Let's just call them Brussels, because this is where all the buildings are, the Parliament and so forth and so on, built in Brussels and Strasbourg. to allow to issue a pan-European bond that doesn't say Germany on it, doesn't say France on it, it says Europe on it. That is the germ, the germ cell of what might become a competitor for U.S. Treasury bond. It takes a long time to get there because, again, anybody who holds sovereign bonds, like a U.S. Treasury bond, they hold it because it's super liquid. You can always buy and sell it. And it's going to take a long time before any pan-European bond gets to that stage. But it still is an interesting germ of a possibility. Now, what happens, of course, if there are other sovereign obligations that look attractive, what it means is that the U.S. government will the U.S. Treasury securities have to have a higher interest rate to make it attractive for somebody to buy the bond. So that's what happens, is that the interest rate on the U.S. Treasury security would have to rise if there were other securities that were attractive. And I would go buy them. I would only, not buy something else that looked attractive is if the U.S. Treasury security had a higher yield. Now, the downside of that, of course, is that makes financing the fiscal deficit more expensive, because that's what that means. To have a higher interest rate on the bond means it's more expensive to finance the fiscal deficit and the national debt.
Yeah, that was an interesting, I'd heard of the pan-European bonds before, but
it's kind of a new thing.
Yeah, so then the last question, that was submitted beforehand would be, what are your thoughts on the Green New Deal and other suggested economic reforms?
Okay. So the Green New Deal, I talked about green, and I said, basically what matters at our juncture right now, where living standards are being hurt, growth in living standards are being hurt, where our ability to repay the obligations is being hurt, labor market scarring, business investment, blah, 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 and where the prospects for younger generations are looking kind of grim. The critical question is, how do you catalyze private sector to start investing in real things? Not buybacks, not mergers and acquisitions, but actual investment, plant, equipment, technology, people. I've argued that a catalyst to do that is a set of policies. They have to be global, climate's global, a set of policies that create incentives for the private sector to invest and for individuals, consumers, to demand different types of energy, effectively energy. And the Green New Deal has some elements of this, but I'm not sure it has enough. And so it also might be one of those things that at this point politically, you would like to have catalytic private sector investment based on a set of incentives to change carbon footprint. But you might not want to call it Green New Deal. So you might have to call it something else. But the end of the story is that, we got a lot of issues coming already. Climate crisis is, it's not like it's in the background. It's kind of like, I don't know, it's the monster under the bed or something. And it's going to come out here. It already is, right? Hurricanes and flooding and the big ice sheet collapsing, and all this. It's pretty much the monster's not far under the bed. So we need to have this done. We need to have these set of policies done, and it has to be, as I say, it has to change private sector decision making. We have to demand different things. It has to catalyze business investment because they have to do different things. They have to do investment. And it's got to have training. It's got to have labor market policies in there, because ultimately, you got to have the workers on board, and they've got to make. There's got to be transition. So how you get around to that it's a bunch of different policies that have to be put into place. It has to be done on a global scale. Otherwise, we're just wasting our time. So we start by going back and rejoining the Paris Accord, and then work from there.
Yeah, so now we're a little over time, but if anyone has some quick questions they'd like to ask before we wrap things up, please speak up and go ahead.
Yeah, I was gonna ask Ms. Mann. You talked about like incentives to changing like private sector behavior.
Yeah.
I was wondering, we discussed this like concept in my econ class a little while ago. Do you think that like an outright ban on stock buybacks, like we had in like before the 1980s, would do a good job in spurring capital investment?
Well, so there are carrots and sticks, right? A ban on buybacks is not necessarily going to do what you need to do, which is to promote capital investment, right? You're stopping somebody from doing something, but you're not actually creating an incentive for them to undertake investment, plant, equipment, technology, and people. So I'm a create the incentives that alters not just the business behavior, but also consumer behavior. Especially if we're dealing with climate, there's got to be consumer behavior change as well. So it's a buyers and sellers have to both do it. So I think it's a pretty blunt instrument. The buybacks is a pretty blunt instrument, and frankly, my view is that that's not going to lead to the outcome that you want, which is benefit on the real side of the economy. And if you can't do a buyback, believe me, they'll figure out another way to do effectively the same thing. So that's why I think positive incentives for changes in business strategy, that's what we really need to be focusing on.
Yeah, I believe in the chat, David Wong asked, are international trade policy decisions more of political decisions nowadays, or are they like economic decisions?
Trade policy decisions basically are political decisions with the objective of achieving a particular economic outcome. But there's, policy always is about politics as well as economics. You can't take the politician out of the word policy, because actually, they were the ones who got elected. People elected them. So it's always part of the political process. I'm going to give you a story. When I was working at the President's Council of Economic Advisors, I'm the economic advisor, right? So one of the things that we had to learn was that you had to remember that the objective function of the person who you were serving, who had been elected by the citizens, was not necessarily the objective function that an economist maximization would deliver. So an economist might say, you should do X as a policy, and here's why. And the politician comes back and says, yeah, I hear that, but I'm going to do these other things instead. Or maybe, choose one from column A and one from column B. And so my job was first to set out, this is your first best option. I know you're not going to do it. This is your next best option in order to get you where you want to go, even though it's not, in a pure world where they didn't have, politicians you could get to. So you had to think about this as you were always going to be deviating from your first best option. And you had to acknowledge that was okay. And what you should have tried to do is to avoid the worst outcome, because there were a lot of people who wanted to do something that was really terrible, a really terrible policy. And it was really important to say, I know where you want to go. Here's something that's a better way, right? So it wasn't the worst outcome, not the best outcome, not the worst outcome, okay? And then to say, okay, I know you're going to do this. Let me just tell you what you're leaving on the table. First best was this. You're going to do this, not the worst one. You're going to do this middle one. How much money did you leave on the table? Whether it was inequality, whether it was jobs, whether it was political alliances or foreign policy alliances, whatever. What were you leaving on the table? And that was my job.
Yeah, so if anyone has any other questions, I believe we have time for like one more. Please go ahead.
Do you think that ESG investing's resilience during the pandemic will lead to its more widespread adoption?
Yeah, so I saw that this other question. So I think it's really important to make when we think about ESG, throughout this, and even before COVID, ESG was very important in Europe. And I think if you were in Europe, and of course I was, when I was at the OECD, they really are taking this seriously. They may not be, I'm not saying that their policies are all the best, but the citizenry there are taking it seriously. In the US, prior to the Trump administration being elected, I think we saw a more vibrant ESG environment where the US entered in the Paris Accord. It was done with bipartisan agreement, and the US and China were on the same page, which I think is a very important thing to remember. So, and ESG is not, there's other aspects of ESG, not just climate, but let's say if there was a different administration over the last 3.5 years, or going forward into 2021, there could be very different policies put into place that would ratify much more growth in the US of ESG. As I say, ESG is already a very well-established investor class and consumer class in Europe. ESG funds outperform their matching non-ESG funds. And as I said, the supply chain, the supply chain reorientation is partly because consumers are demanding to know about what's going on with their products. And this is really important in Europe. It's sort of important in the US. It might become more important in the US going forward, depending on outcomes. So I do think, and frankly, there's a lot of money waiting to participate more actively in ESG. So you've got consumer demand for ESG products. You've got money waiting to finance ESG projects. You've got companies saying, if I do this, I'm going to be able to get money for it. You know, I'm going to be able to get financing for it. So we're on the cusp. I think we're on the cusp of actually being able to tip in to an effective climate strategy. It requires leadership at the top, and it requires global commitment and agreement. And we did have that with the Paris Accords, but you know, we've sort of retreated from that in the current environment.
Yeah, so first off, I'd like to thank Ms. Mann for taking the time out of her day to talk to all of us, and then our members for signing up. We encourage you to attend our next event, the JEC and CARE Financial Education Panel, Sunday, August 30th at 10 a.m. And also I'll be sending out a follow-up form later today where you can provide feedback. And yeah, thanks for coming, everyone.
Thanks for it. See you in a few years, I hope. All right? Bye.
Definitely. Bye.
Bye.